I just wanted to say welcome everyone and introduce myself. I'm Christine Frost, Vice President of Investor Relations here at Equity Residences. I head up our East Coast operations here in the Boston and New York regions. I wanted to take this opportunity to welcome you, our participants, to our webinar tonight. We're very excited you decided to join us and spend some time learning more about what we do. So welcome. Thank you for coming. Now we work with accredited investors. This isn't a solicitation to sell an investment, and if any of you are interested in receiving our prospectus, we'd be happy to arrange that afterwards. As well, you'll see an icon, you should, on your screen with a hand, and if you have questions throughout the webinar, feel free to push that button and we'll get to you as quickly as possible. Let me just move forward here. So as some of you may know already, Equity Residences manages a number of unique private investment funds owning luxury vacation properties. And the goal of our funds is to provide innovative and financially attractive vacation real estate, or the most attractive investment vehicle in the market today. And just a little bit about our team, our directors to begin with. And we've got Ken Hamlet, a senior advisor at Crestview Partners, but most notably serving as president and CEO of the Holiday Inns Hotel Group. Another director is Steve Deering, founding partner of DCP. We've also got on the phone Greg Sally, who will be speaking next. He can tell you a little bit about himself, as well as John Long, our director as well.
Hi, everybody.
And now I think what I'd like to do is turn the floor over to Greg.
All right, thank you, Christine. And just to really reinforce our team, Ken Hamlet has years of experience in the hospitality industry. Christine mentioned he's CEO of Holiday Inn, but he's just got a tremendous experience both on the financial side and on the hospitality side. Steve Deering, Christine alluded to DCP. Well, he was one of the original founders of the fractional industry. He developed that industry. He's been involved with a number of hospitality developments, both inside and outside the country, and has brought just a wealth of knowledge to our team. I'm Greg Sally. I have a varied background ranging from consulting at A.T. Kearney to more recently focused on a lot of mergers and acquisitions and real estate investing. And then John Long, who you'll hear a little bit later on the call. Again, a lot of experience in management consulting, private equity, etc. So we've got a really, really strong team we've built. And then you heard Christine on the introduction. She actually recently joined us, and she has a variety of experience in this particular industry, dealing with different types of investors in vacation clubs, etc. However, and you'll see this on the next slide, we really believe that we've developed a truly innovative model for the industry. John and I and our director team came up with this model about 1.5 years, 2 years ago. It was truly innovative at the time. It's still innovative. But the new thing that we can say about it over the past 1.5 years or 2 years is it's a very proven model. We've gone out, we've brought in a number of investors, we've raised capital, purchased properties for 40 to 60 cents on the dollar, and actually all our properties have been purchased at this point for 45 cents on the dollar or less. In fact, 2 weeks ago we closed on a property that was closer to 30 cents on the dollar. We've shown through renting the properties that we can cover our operating expenses through rental income. What that means is, as part of being a great investment, you don't have to fork out money for property taxes and utilities and all those things you might have to do if you were to just say go buy a vacation home yourself. We were able to, as a result, cap what the annual operating fee can be and use instead rental income to cover those expenses. We also provide an investment that you get to enjoy today. So when you invest in an Equity Residences fund, you get to enjoy the properties. Each year you get guaranteed usage. If you don't have the time or ability to use it that particular year, no problem. You ask us, we'll rent it for you. You'll get the rental income in the form of what we call a capital dividend. So you really get to live for now and invest for the future at the same time. In addition, we have a liquidation event. So we're going to sell these properties for a capital gain and distribute the proceeds to investors. Now remember, I said we were buying these things for 40 to 60 cents on the dollar. So far it's been for 45 cents or less on the dollar. As we see, and that's from the peak of the market. So as we see these properties start to turn around, which we've already seen about 25% depreciation in our portfolio, we'll be selling these properties and then distributing the proceeds back to investors. Now, I think it's always interesting to see what the smart money guys are doing, the folks that spend all their time thinking about what are the best investments out there. And, last year Warren Buffett was saying I'd buy a couple hundred single-family residences if I could. Blackstone actually went out and did this. They're now the largest owner of single-family residences in the U.S. However, more recently, Paulson, who's been very astute at investing in the real estate market, made $4 billion back in 2007 with subprime mortgage defaults, has strong performance so far this year. He's putting his money where his mouth is as well. He's invested in a number of real estate initiatives, and one of the quotes he had from back in July is buying a house is the best possible investment. If you already own a home, buy a second one. He even went as far as to say it's a better investment than investing in him. And he thinks we're just at the beginning of the recovery. He sees 4 to 7 years, and it's not too late to get involved. So again, it's just good for context to see what the other guys are saying. And we can tell you what we're seeing is that we can still find great deals, we can get appreciation right away, and we can cover those operating expenses with rental income. Now I'd like to turn it over to our other director, John Lum.
Hi, everybody. So I want to shift it and talk about why we're investing in vacation properties as an asset class. And it's something that the folks like Buffett and Blackstone and Paulson, they're not doing, and that's what we're unique. And I get asked a lot, isn't it too late? Aren't the prices already raising in real estate, and isn't it too late for this opportunity? And frankly, the answer is no, and it's why we're focusing on this vacation property asset class, because the hedge funds aren't pouring $1 billion into $1 million homes on the beach. It's harder for them to do, and it's something that a smaller fund like us can focus our efforts, become experts in this asset class, and then deploy our capital and reap really significant gains. Vacation properties were hit really hard during the downturn. So all these properties, they're recovering, but they're recovering from 10-year lows. And not only are they 10-year lows, but the current value of these vacation properties are below replacement or construction cost. So the investment thesis that we're pulling together is that we're buying these coveted assets. So to point 3 there, they're in prime locations. So we're not just buying any vacation properties. We're buying the scarce, limited resources, if you will, right? There's only so many oceanfront, beachfront, ocean view, slopeside, ski-in, ski-out types of properties. So we're going in and buying this coveted, scarce, limited resource that we're buying below construction cost, so that when any market recovery happens, we're really kind of limiting our downside risk. In any market recovery, properties are always selling for below construction cost. So we're feeling that the buys we're making really have this limited downside risk, and that our return of capital to our investors is nearly guaranteed. The other point behind just the asset class and the opportunities we're able to get in the value here is that rental income can cover all the holding costs of this investment. So we do know we're buying an asset that we can cash flow. And then more importantly, as I mentioned right at the onset, is that vacation properties are going to take longer to bounce back. So this window hasn't closed yet, and even though the market's recovering and some real estate has recovered in many markets, folks aren't yet out taking discretionary capital and buying $1 million homes on the beach. So we're going into markets like South Florida, where the market may be up 20+% since the downturn, but then we're finding these great oceanfront and waterfront types of properties that we are still getting at 40 to 50 cents on the dollar, because that discretionary money of high net worth individuals buying second homes just really hasn't taken off yet. So we're capitalizing on that. Chris, next slide. So here's some vacation property trends. So the market hasn't turned around yet, but we're seeing activity. So vacation homes were up 10% last year, lifting median vacation home prices up. The investors they're very active in this market, but it's not the large billion-dollar hedge funds. So it's smaller investors, but that are going in doing all cash sales of foreclosed properties. Cash sales actually accounted for 46% of all vacation home transactions. So it is an active market, but it's an active market that we can participate in and get those deals that you'll see in the next couple of slides that really create opportunity for our investors. So I think I kept reiterating this, that distressed deals can still be sourced. And it's something that we basically bring to the party, in that Greg and I and our team of the property acquisition folks we have on our team have really become experts, and we become expert in the local market. So we're very, very good at buying distressed properties, and then we build a real local market expertise so that we know what to buy and when in each local market. So our team, we kind of divvy it up, and we become experts in maybe, call it 5 to 6 markets at a time, because we don't decide our next property is going to be in market X. We look at it, we make sure that we're ready to buy in about 6 different markets. We really understand the local market economics. Frankly, we become much smarter than any of the local brokers or agents in the market. Now, we can't do this alone, so we do find the best broker we can in each local market. We partner with somebody locally. They're instrumental to our process, because our local partner is feeding us the deals that other people may not know about. They're getting us the market data that we need to do our analysis. But then we're doing a data-driven approach, and we're building market models for each market. And we don't just do comps for an entire market, like the property we just bought in Longboat Key. We don't do a market analysis for all of Longboat Key or all of Sarasota. We go down to the neighborhood. We understand neighborhood, block level. In Park City, we basically did our analysis, so every 3 blocks within Old Town would have a different set of comps. And we just get very smart to where, what I always tell people is kind of the morning coffee. We see all the deals in the different local markets, and we know whether we should be making offers that day or not. And Palm Springs is an example. We saw that deal at 8 in the morning over coffee, and by 9 a.m. we'd locked it up and taken it off the market. Now, we do that sight unseen, and we do that knowing that it's the best deals are going to be gone, and we lock them up. Then we always have the due diligence period when we know we can go in and understand whether we do want to buy it or we want to just return it back to the market. So if you look at the next slide, we'll talk about some of the deals that, well, actually, sorry, we'll talk about the portfolio. So that expertise that we have in those different markets, we've already deployed that in Kapalua on Maui, in Deepwell in Palm Springs, California, Longboat Key outside Sarasota, Florida, Mammoth Lakes, California, and we recently just bought 2 properties in Park City that we'll talk about in a minute. We're going to keep one for the fund, and then we're going to sell one for a gain for investors. And then you can see here on this page we have targeted beach, targeted ski mountain, and other targeted leisure. When we launched the fund, we did our analysis. We knew the markets that we could buy in. This isn't a 100% list. This will change as we go through and buy properties. I mean, at the end of the day, first and foremost, our goal is return on invested capital for our investors. So we're going to make the best investments, the smart investments. And so, we don't want people investing in our fund thinking that they're guaranteed to have a place in Scottsdale, Arizona. It may not happen. If it's not in the best economic interest of our partnership, then we won't make those decisions. So we're clearly, we're not a leisure fund, and we're not doing this just so folks get free vacations. And it's a nice benefit, but as Greg will talk about later, there's the benefit of vacations, there's a benefit of rental dividends. But first and foremost, what you'll see in the next couple charts is that we're making really astute, smart investments for our LPs to return them significant gains when we close the fund. So here's an example. Maui was one of the first properties we bought, and this was an example of buying a property in a great location, right? So we found some of our best deals are we find the perfect location with a property that has great bones, but that doesn't show well, right? And so this property it needed some tender loving care. They probably hadn't done anything inside the property since the mid-'70s. And it's something that a soccer mom walks through this property, she wouldn't want to buy it. But we walk through it and we see the opportunity. It has sweeping sunset ocean views from every room of this villa. And it was a villa that was a two-bedroom that we could convert to a three-bedroom. And we saw that opportunity. It had a huge loft area that had been enclosed and extra kind of study rooms off to the side that had never been kind of fully enclosed or converted. But it's something that when we go through these properties, we look for those opportunities. So if you look at over the chart on the left, you'll see kind of properties in Kapalua, particularly within this resort area within Kapalua. Average was $753 a square foot during the peak. Kind of running average was $538 when we bought this, and we ended up buying it for $346. So at the time, we bought one of the best values within Kapalua in 2012 when we bought this. It was 46 cents on the dollar to the peak. Cash flows with only 27% utilization. We always do our P&L on these properties to ensure that we can cash flow these because it's part of our model. But at the end of the day, you see the chart there. I mean, at the peak, these units are selling for 1.2. When we bought it, people were still getting, in the high 8s to the, mid-9s, and we got our property at $600,000, then put money into it for a remodel. But at the end of the day, if we were to sell that property today, we would sell this property for about $1 million already, and that's how our portfolio is already up, and it's up because of our property acquisition expertise of finding these gems. So the next property is similar to Longboat Key, and this is another example of a house with great bones that's sitting waterfront on Sarasota Bay that, again, had pink tile all throughout. It didn't show well. It was an estate sale. I didn't mention the Maui property was a short sale, so that was, again, where we were using our expertise negotiating with lien holders to get an amazing deal. And frankly, that property, the great story behind Maui was that even though we bought it as a short sale, it wasn't listed as a short sale. We did our homework, and we knew the liens that were on the property. We knew the HOA back dues that were due, and we knew that the seller would never be able to sell and actually pay off all their debt. So we did a proactive, unprompted short sale at a really low-ball offer that, at the end of the day, the seller, when he was fully educated on what he was sitting on, had to take, and then it was up to us to close with the bank, which we did. In this case, it was an estate sale, but again, if you look at the chart, properties in Sarasota, they're kind of selling at the point where when we were able to get this, we got this for 46 cents on the dollar. It's another case that cash flows with only 25% utilization. And in a similar situation here, these properties in this area selling for $1.2, $1.3 million in the peak, recent comps at 708, we bought this property. At the end of the day, I think Greg, was the final number 625, 630?
No, we bought it for $639.
$639. We then put $125,000 into it. So, our basis was under $775,000 in this property, and it was recently, we did an informal appraisal, and we would sell this somewhere between $900 and $975 if we were to sell this today. So this is another example of, it's not just that we're buying properties at 40 cents on the dollar. We're buying such great deals, creating value in them, because similar to Maui and Longboat Key, we took a 3-bedroom house and converted it into a 4-bedroom house. So we're creating that extra living space. And then we took a house that just hadn't had any work done onto it, again, and probably since the early 80s, and did a complete retrofit, new flooring, new fixtures, bathrooms, kitchens, furniture, and really created a luxury waterfront house, that, instantly, with a 775 basis, we have a house that's worth close to $1 million in this case. Now, my favorite is the next one in Park City. So I'm actually calling in from Park City today. We're managing a construction project on this house as well. Here's an example. If you look at the bottom chart, this is a 2-unit house. You'll see this long, big house that goes up the hill. It's a 5-bedroom, 5-bath, and a 3-bedroom, 3-bath. It's 8,000 total square feet. Well, this had a peak value of nearly $6 million. And we just purchased it for $1.8 million, so 30 cents on the dollar compared to peak pricing. Now, this was us sourcing a really seriously distressed property that was owned by a mortgage fund out of Boca Raton, Florida, and it was all sorts of trouble. At the end of the day, this house didn't have a certificate of occupancy, so nobody could sell it and move in. But we did our 12 weeks worth of due diligence and work with the building department in Park City to really understand everything that needed to be done to this house to get a certificate of occupancy. This house was one in that the builder went bankrupt. He built this in the peak in 2007, spared no expense at the peak with fit and finishes, and they built a beautiful house, but then never finished it and went bankrupt. Nobody's ever lived in this property, and we're finally the first ones to get it from the bank. And basically, we're going to put an extra $200,000 into it, have a $2 million basis. It'll be worth somewhere around $3 million when we're done. So there's an instant $800 to $1 million equity bump for our LPs the day we finish and get our CO, which is sometime in mid-January. So that kind of segues into this slide that Greg will talk about, which, you know, is...
Well, thanks, John. So, you know, John talked about our property acquisition strategies, gave a few examples of properties in our portfolio, but what's the net result of all that? Well, in the first year, we've seen appreciation of our properties conservatively of 25%. Secondly, we've also seen our net asset value of our current portfolio continue to increase. And let me explain net asset value. So net asset value is effectively the value of all our properties that we own as a fund minus any debts or outstanding liabilities we have, and then dividing that by the total number of investment units that are outstanding. Now what's interesting about this is you can see our current net asset value is $106,000 per unit. Yet the current investment in the charter round to invest for one unit is $96,000. So we're in a situation where the moment you invest in the fund, you've made a $10,000 profit as compared to the net asset value. As a result, our current partners are saying, wait a second, why are we allowing new investors to come in for $96,000 when they're investing in a portfolio that's already worth $106,000 conservatively? And as a result, you're going to see that we're doing a price increase here shortly. So that price will be going up, and we expect our net asset value is going to continue going up as we continue to make these great investments. The other thing John mentioned earlier is that we can still source these types of deals. In fact, I would argue that the Park City property that John was out working on today is probably one of our best deals in terms of driving our net asset value we've made. And we just closed on that property 2 or 3 weeks ago. So we're still finding them. We still know where more deals are out there. And as we bring in additional capital from investors, we're going to continue to add to this portfolio. And I mentioned this early on, but this truly is a proven model, and you can see it in these results. Now, there's another side to our model, and that's what we call our usage dividend or capital dividend. In layman's terms, it's getting free use of these properties, these just amazing properties all around the country and eventually outside of the country, and it's the ability, if you don't use it, to derive rental income from that. Now, let's do the math together. We're estimating that peak rental income for our property portfolio is around $5,000. And that off-peak, it's about $3,500. Well, for someone who invests just the minimum, which is 1 unit of investment, you get 2 guaranteed visits per year that can be used during a peak time period. Now, there's a small caveat to that. We do have 3 blackout weeks per property per year. In the case of the Park City, it's 2 weeks at Sundance, it's a week at Christmas. But in general, you have access to peak time, peak ski season, and you get 2 guaranteed visits at any property. It doesn't have to be Park City, it can be Florida, Hawaii, wherever you want to go. Now, if we do the math, though, those 2 weeks at $5,000 each, that's about $10,000 a year. Our intent is to hold on to these properties for roughly 10 years as our holding period. So $10,000 a year times 10 years, that comes out to $100,000. So you see the big $100,000 at the bottom. That's the rough estimate of what the value of this usage is worth. you're investing $96,000. If you think back, one unit right now is a $96,000 investment. It's already got a net asset value of $106,000. Over 10 years, you're going to get $100,000 roughly of free vacation usage, and then we're going to have a liquidation event. We're going to sell the property. You're going to get your original investment back. You're going to have all that great use or the rental income that you derive from it. And then you're going to get the appreciation for properties that we're buying 40 to 60 cents on the dollar. I don't know what these are going to be worth in 10 years exactly, but I do know that we've secured some great deals. They're going to be worth a lot more than they are now. Some of them will probably go up by well more than 100%. Some may go up by a little less. But across a diversified portfolio, you're going to see a significant opportunity for appreciation. So there's a lot of components to this investment. There's a lot of things that make our model truly unique and innovative. And to me, I've heard a lot of people say this to me, that it's almost like a no-brainer investment, because even if the properties don't go up in value at all, I'm getting all this free vacation, that I'm getting $100,000 of free vacation, and I'm getting my money back when we sell the properties, but I know that they're going to go up. I just don't know exactly how much. Next slide. The other thing that we haven't touched on, we have such a strong investment story that we haven't really touched on the experience, but there is a great experience side to this as well. As a partner in the fund, these are your properties. We want these to feel like they're your second homes. We want you to feel comfortable and invited and welcome and pampered when you get there. And we're doing a number of things that we call the equity experience to make you feel that way. One is, these aren't just cheap linens we're putting in these properties. We want a luxury feeling. We've got high quality linens, fine toiletries and soaps, beach and pool towels. Like literally when you arrive at our Palm Springs house, you'll see the beach towels folded over the chairs, and everything's like you're arriving to a fancy resort. We've got sports equipment, some great things like beach cruisers. We've got paddle boards. It's really appropriate to whatever the location is, but we have paddle boards in our Longboat Key property. We've got a two-person kayak. There's a dock right out back, so you literally just drop it right off the dock, hop in, and you're off and going paddling in the water. We've got, in Hawaii, we've got boogie boards, so you're out riding the waves right from the property. We've got beach chairs and coolers and all these great things, so that wherever you happen to be, you've got all those fun toys to play with. We've got flat screen TVs and entertainment tablets, and John's really taken the lead to push this forward in terms of each property is being stocked with a tablet where literally you can go in, and on this tablet you can access entertainment in terms of Netflix and Hulu and music, and stream it right to the TV, and it's being set up in a way that's just really easy and intuitive to use. We also are putting fresh flowers in the properties when you arrive, so you've got that nice touch to welcome you to the property. And then we're also stocking some food and beverage prior to your arrival, so no one wants to get off a flight to, say, Hawaii and then immediately have to go to the grocery store. Well, you don't have to worry about that. You've got some basics to snack on, make a simple breakfast, enjoy a nice glass of wine or local beer. So if you're in Hawaii, you're going to get a nice beer from one of the local breweries, whether it's the Kona Brewery, etc. So the experience is a big part of this, but the investment story is really what makes it come together. Now let me talk about the next slide, where we talk about a testimonial, and this is just one example from our Palm Springs property. Our Palm Springs property is just a beautiful mid-century modern property. It's in the Deepwell area of Palm Springs, a lot of historical value there. And this property is actually one of the few properties that we didn't remodel. We were able to get this property pretty much turnkey, and John mentioned it earlier. We bought this property literally within an hour because we knew it was such a good deal, and we locked it up, and then immediately the seller tried to actually come back and renegotiate it with us because they realized they had sold it for too little. But it was a short sale, and it had 2 lien holders. We went through a negotiating process with both lien holders, and as soon as we closed, we had created value from day one. What I love about this property in Palm Springs is it's really the whole property, the house, is centered on this beautiful pool area. And It's a great property for bringing family or friends, and everyone just kind of bonds because you're just drawn to this pool area. The kids, if you have kids, are just hanging out, having fun, jumping in the pool. The adults love it, and it really provides an opportunity to connect with other friends and families. And one of the nice things about our properties is they tend to be larger properties. This one's 3,500 square feet. Park City is actually 5,000 square feet, but they have sleeping capacity for anywhere from 8 to 16 people. So you can bring in groups of friends and family. You can truly spend time together and bond and really reconnect. We've also heard many testimonials like this from other partners that have had a chance to stay at Palm Springs or any of our other properties, and it just always comes back. It was much better than they ever expected when they invested. So what does this mean at the end of the day for investors? Well, to join the fund, it's a one-time upfront investment starting at around $100,000 for the equity villa fund. Now, a lot of our investors, the exact investment right now before the prices go up is $96,000. A lot of our investors actually invest 1.5 units, which is $144,000, and that's because you're getting a lot of extra value there. For the minimal investment, you get 2 guaranteed weeks of usage, but you also get unlimited space available. Well, if you increase to 1.5 units, you're getting 4 guaranteed weeks of usage plus that unlimited space available. And so that's kind of been the sweet spot that a lot of people go for. You're also getting a preferred return. So preferred return meaning you're getting your return before us as general partners and directors managing the fund get a return in the form of that vacation usage for free, or if you elect, we can rent that out for you and you can get the rental income instead. You're getting long-term capital appreciation from holding a low-risk asset. And let me explain that, because people have lost money investing in real estate, but they were usually doing it in very leveraged or risky ways. We are in a very unleveraged situation. We've taken on a slight amount of debt to accelerate capital appreciation or property acquisition early on, but the fund essentially holds the properties debt-free, meaning there's no forcing factor that we'd ever have to sell these properties until we decide that it's the right time to sell it. We also generate cash flow from the vacation rental income that more than covers operating expenses. So there's no reason we should ever have to sell these properties in an environment that it wouldn't make sense to sell it. We're also diversified with properties all across the country in different locations, which further reduces the risk. Now, we do have a liquidation event in 10 years, so we anticipate, real estate always goes through cycles. We don't know the exact duration of the cycle, but in roughly 10 years, we'll be liquidating these assets, returning that capital back to investors, plus their gain in value. And as we mentioned earlier, the property values have already increased by over 25%. Our net asset value is higher than the cost to invest in. And then I just got done talking about that experience in terms of really wanting to pamper you, make you feel like this is your home, and you personally own a portfolio of some amazing properties all across the country. Next slide. So in terms of next steps, to invest in the fund, you can contact any of us. You heard Christine earlier in the call. You heard John, myself. Express your interest. We do need to verify that you're an accredited investor, and we can talk you through that. We also need to review the fund documents. A lot of people want to take those, review them with either their legal or financial advisors. And then once you're comfortable with the investment, return an executed copy of the subscription booklet to us, and you'll fund your investment and you'll become a partner in the fund.
Great. Well, that'll conclude our webinar for tonight. Thank you all for coming. Really appreciate it. And again, feel free to contact any of us. We'd be more than happy to answer any questions you have and talk with you directly.
Thanks, everybody.
Thank you.
Thank you.